Welcome to the Deep Dive. Today, we're digging into the full year 2025 earnings release from Ryanair Holdings PLC. Our goal here is pretty simple. Cut through the jargon, unpack the numbers, what management said, and really figure out what it all means for them going forward. So right off the top, the headline numbers, profit after tax came in at $1.6 billion.
Yeah, that's down from $1.92 billion the year before.
And the main reason they gave was a drop in airfares.
That's right, a 7% decrease on average. And what's really interesting, they almost seemed, well, proud of that figure.
Proud of lower fares hitting profit. How so?
Because they directly linked it to driving serious traffic growth. They framed it strategically.
Okay, and the traffic numbers show that.
Absolutely. Traffic grew by a strong 9%. Hit a new record, actually 200 million passengers.
Oh, wow. 200 million. So the lower fares definitely filled the planes.
They did. And this was despite, those repeated Boeing delivery delays last summer, which could have really slowed things down.
Right. So more people flying, even if the tickets were cheaper. How did that affect things like baggage fees and seat selection, the ancillaries?
Good question. Total ancillary revenues were up 10%, basically right in line with the traffic growth.
So they made the same amount extra per person.
Actually, slightly more. The unit ancillary revenue, the average per passenger was up 1%. So yeah, they got a tiny bit better at squeezing extra revenue from each passenger, even with more passengers overall.
Okay, let's switch gears to costs. Always a huge focus for Ryanair. They said unit costs were flat.
Flat. That's the standout figure, really. Unit cost per passenger, totally flat last year.
And that's a big deal because...
Well, management didn't hold back. They said this meaningfully widened the cost gap between them and their competitors in Europe.
Okay.
It just strengthens their main competitive weapon, their ability to undercut rivals on price and still make money. They see it securing their growth path for the next decade.
So with that cost advantage widening, are they planning a big growth spurt this year, fiscal 26?
Not quite yet. Growth is actually going to be pretty constrained this year.
Still the Boeing issues.
Still the Boeing issues. They're only expecting to get, I think it's 29 of those delayed aircraft delivered this winter.
Okay.
So that really limits growth for the summer 26 season. They're targeting only about 3% growth, reaching maybe 206 million passengers.
So just a small step up from the 200 million.
Exactly. They do expect things to pick up more in FY27, maybe hitting 215 million then, assuming the planes start arriving more reliably.
It sounds like they're incredibly efficient, but just short on the actual planes right now. Did those delays have any knock-on effect on their cash?
Actually, yes. In a positive way, weirdly. It boosted their cash balance.
How's that?
Well, they didn't pay for planes they expected to receive, so the cash just stayed put. They ended the year with $4 billion gross cash and $1.3 billion net cash. Pretty strong.
And they're using that cash. I saw they did a big share buyback.
They did. Last year, when they issued that profit warning, they took the chance to buy back and cancel 7% of their shares. Good return for shareholders.
And another buyback coming?
Yep, another $750 million planned soon. But honestly, the really big news on the cash front for the next year or so isn't buybacks.
No. What is it then?
Debt reduction. Paying down bonds. They've got a big one, $850 million due this September.
Okay.
And then an even bigger one, $1.2 billion in May 2026.
And the plan is just to pay them off?
Completely. Using their internal cash balances. The stated goal is to be entirely, or almost entirely, debt-free by this time next year.
Wow. Debt-free. For an airline with that many planes, that's huge.
It's a very powerful position. Think about it. Almost no debt. A massive owned fleet, lowest costs.
Okay, let's look at the other side then. Pricing. For this year, FY26, they said last year's comparison was weak.
Yeah, unusually weak, especially Q1. Couple of things going on there.
Like what?
Well, Easter was fully in April this year. Last year it was split. That helps Q1. And they sorted out that spat with the online travel agencies, the OTA boycott.
Right. I remember that.
So now most of the big OTAs are back booking flights properly, which is boosting demand. Forward bookings for the summer are actually running about 1% ahead of last year now.
And that's translating into higher prices right now.
Definitely in Q1. Fares are currently up like 15% compared to last year's weak Q1.
14 to 15%. Okay, what about Q2?
Still early days for Q2, but it looks like fares are maybe up 4 or 5% right now. The hope is they can recover a good chunk of that 7% decline they saw in Q2 last year. Maybe not all of it, but a significant amount.
But visibility further out is low.
0, basically, standard for this time of year. So no full year guidance. The cautious vibes is they expect to recover most of last year's overall 7% fare drop across the full year, but probably not all of it.
Depends on summer bookings.
Exactly. How strong those close-in last-minute bookings are and what yields they get in the peak summer months. And, the usual caveat, geopolitical risks could always throw a wrench in the works.
Okay, sticking with FY26, costs. After keeping them flat last year, what's the outlook? More inflation.
Very modest inflation is the forecast, maybe up just 1-2% on the unit cost level.
Really? Only 1-2%, despite, everything. Fuel, staff.
Well, they specifically mentioned some big headwinds they are facing. Route charges, ATC charges, those are going up. And environmental costs are jumping significantly.
Environmental costs. What's behind that big jump?
It's mainly two things. The phasing out of free ETS carbon allowances, meaning they have to buy more permits, and new mandates forcing them to blend in sustainable aviation fuel, SAF. Both add quite a bit to the fuel bill.
And they think analysts aren't fully grasping that impact.
That's what they said. They pointed out their environmental charges going from about $850 million last year to over $1 billion this year. That's a big chunk of change.
So how are they keeping overall costs almost flat then?
Offsetting factors. More deliveries of those fuel-efficient game-changer MAX aircraft help. Strong fuel hedging they put in place earlier helps. And just their usual relentless focus on cost control across the whole business.
Makes sense. Did they say much about staff costs? Pay deals?
Yeah, they mentioned pay increases are already locked in under existing multi-year deals, just modest increases in the later years. The next big negotiation cycle isn't until March 2027.
Interesting timing.
Potentially timed, yes, to coincide with expected productivity gains if and when the bigger burning MAX 10 aircraft start arriving.
Speaking of Boeing, given all the delays and issues, how's that relationship now?
Management actually said it's materially improved over the last year. They give a lot of credit to the new management team at Boeing.
Really? So things are getting better on the production side?
Seems like it. They noted fuselages arriving from Wichita are on time now, fewer defects. And Boeing delivered 45 planes to them in April, compared to just 24 the previous April. So positive signs.
Any update on the certification for the other MAX variants, the 7 and the 10? Ryanair really wants that MAX 10, right?
They do. Boeing is apparently reasonably confident both will get certified before the end of this calendar year.
Okay, so deliveries could start.
If that timeline holds, it sets them up for MAX 10 deliveries starting spring 2027. That's the plane with more seats, better economics.
And if certification slips again?
Management mentioned Boeing have a fallback plan. They could apparently ramp up production of the current MAX 8-200 version instead. It's not as good as the 10, but it would still let Ryanair keep growing its capacity.
What about tariffs? There's been talk of potential U.S. tariffs on aircraft. Any concern there?
They didn't seem overly worried. They said their Boeing deal is fixed price, so the cost shouldn't change for them.
Okay.
And they mentioned they have flexibility on where they take delivery. They could potentially use their UK airline certificate, their AOC, to mitigate any tariff risk if it actually happened.
Okay, let's zoom out a bit. The wider European market, how does Ryanair see capacity shaping up?
They think short-haul capacity in Europe is going to stay tight, constrained, right out to 2030.
Why so long?
It's a combination of factors. You've got Airbus operators dealing with those Pratt & Whitney engine issues requiring lots of repairs, plus ongoing manufacturing delays hitting both Airbus and Boeing. Fewer new planes coming into the system overall.
And less capacity usually means
better pricing, a more benign pricing environment, as they put it. Fewer empty seats chasing passengers.
So it's consolidation.
Right. They pointed to Lufthansa buying ITA, Alitalia, and the likely sale of TAP in Portugal. Fewer bigger players. As the #1 airline in Italy and Portugal already, Ryanair expects to benefit from that consolidation in those markets.
Makes sense. What about the regulatory side? Any frustrations there?
Oh yeah, definitely. They voiced clear disappointment with the EU, particularly the lack of action on ATC reform.
The air traffic control strikes.
Exactly. They want protection for overflights, flights just passing through a country's airspace during national strikes. It causes massive disruption when controllers in one country walk out. They also took issue with Spain's proposal about unlimited free cabin bags. Called it a breach of EU rules, disruptive. You get the picture?
Yeah. Any other regulatory points? Environment?
They reckon the SAF mandates might need to be pushed back. They noted oil majors seem to be dialing back investment in renewable fuels.
Interesting.
And they're still pushing for Europe to shift environmental taxes from the current ETS system to CORSIA, the global scheme. They argue it's a level playing field issue, but admitted no real action seems likely there yet.
So given their own growth is constrained this year, are they being picky about where they put the few extra planes they do have?
Very much so. Demand is solid, they said, but with limited planes, they're being selective.
Prioritizing.
Airports offering growth incentives. Countries cutting taxes. They mentioned regional Italy, Hungary, Sweden as examples.
Yeah.
And pulling back from places raising taxes, like parts of Scandinavia.
Any specific airports mentioned?
They specifically called out Dublin, saying its growth is capped because of government inaction on the passenger limit there.
Got it. Any other sort of corporate housekeeping updates?
Yeah, a couple things. They mentioned that following a regulatory change in March, non-EU shareholders can now buy their shares or ADRs freely. Voting rights are still restricted, but it helped them get into the MSCI World Index recently.
Yeah, okay. Index inclusion, always helpful.
Also, some quick comments on travel trends. Anecdotally, they're seeing maybe a bit of softness in Europeans traveling to the U.S. for leisure.
Meaning more might holiday within Europe instead.
Potentially. But they were quick to say that's probably not the main reason European fares are strong right now. It's more about the capacity constraints we talked about.
And there was a leadership change mentioned.
Yes, the planned retirement of their long-serving CFO, Howard Miller, at the next AGM. They acknowledged his big contribution over the years.
Okay. Let's talk tech and operations. Any interesting updates there?
Yeah, they touched on work from Ryanair Labs. A new system called ROCKS stands for Ops, Crewing, Scheduling.
What does it do?
It's basically automating how they manage crews, especially during disruptions. Instead of manual allocation, maybe just alphabetical. It uses algorithms to assign available crew based on flight hours, schedules, rest requirements, more efficient, faster recovery.
Sounds smart. Anything on the customer-facing digital side?
They mentioned Ryanair Prime, that $79 annual subscription thing.
Oh, yeah. The membership. How's that doing?
Unexpected. Well, apparently. Got 30,000 members already. Management seemed surprised, even hinted they might have underpriced it.
Ah, okay.
They're also aiming for 100% mobile boarding passes via the app by November. And using machine learning, Gen AI, for dynamic pricing. Standard stuff for airlines now, but they're doing it.
And capital spending, investing in infrastructure.
Big plans there. Significant investment coming over the next 3-4 years to build 2 of their own engine MRO shops.
MRO maintenance?
Maintenance, repair, and overhaul. Bringing engine work in-house is seen as a major long-term cost-saving move. Huge potential advantage.
And that spending isn't fully in the current guidance.
Not the MRO shops, no. Current CapEx guidance is about $2 billion this year, dips a bit next year, then ramps up towards $2.53 billion in FY28. The MRO spend is likely on top of or factored into those later years.
Got it. What about geopolitics? Any impact on routes?
Well, the main one mentioned was ongoing disruption to flights to Israel, Tel Aviv.
Still suspended.
Intermittently, it sounds like. If it keeps going, they said they'll look at reallocating those planes somewhere else.
And Ukraine.
Still a major focus for potential return, but they're pretty blunt.
Yeah.
They'll only go back quickly if Ukrainian airports offer aggressive discounts to rebuild traffic fast. They're not going to pay standard charges for empty airports.
Understandable. Okay, one last area of management incentives, share options.
Right. The current big management share option scheme, it vests in 2028.
2028, that's still a ways off.
Exactly. And vesting depends on hitting tough targets, either a 21 share price or $2.2 billion in annual profit.
Could they hit those targets sooner?
The profit target might be achievable relatively soon, based on their outlook. But the key point management made is, even if the targets are hit, the options don't vest until 2028. So executives need to stick around and keep delivering.
Keeps them focused? Any talk of future schemes?
They suggested another big option scheme like this one is unlikely. Future incentives will probably be more traditional LTIPs, long-term incentive plans. Maybe cash or restricted stock tied to performance over several years.
Okay, so pulling it all together from this Ryanair deep dive, it was a year where profit dipped because fares fell.
But they used those lower fares to drive record passenger numbers. And crucially, kept unit costs flat, widening that all-important cost advantage.
Yeah, that cost gap seems key. Growth is a bit stalled this year purely because of the Boeing delays.
Right, a temporary constraint. But they're using this period and their strong cash flow to do something pretty major, aggressively pay down debt.
Aiming to be nearly debt-free within about a year, while competitors are struggling with costs or fleet issues.
Exactly. And pricing looks much better this year so far. Better demand, sorted out the OTA issues.
Though they still face regulatory headaches and the usual geopolitical risks. But the focus seems laser sharp. Cost leadership, efficiency, and now building that fortress balance sheet.
And investing strategically in things like those engine shops for future cost savings.
Right. So this is not financial advice. Absolutely not. But here's a thought to mull over.
Go on.
Ryanair is on track to be basically debt-free. At the same time, they're investing heavily in widening their cost-led MAX 10s eventually, those MRO shops. What does that combination unlock?
Financial firepower, plus an even bigger cost advantage than they have now.
Exactly. How could that fundamentally change how they compete in Europe over the next 5-10 years, especially once these current capacity constraints eventually ease up industry-wide? What strategic options does being a nearly debt-free, ultra-low-cost giant open up?
Yeah, what could they do differently then? Definitely something to chew on.